Okay, good afternoon guys. Welcome to this ECB Debrief for Wednesday the 15th of April. Very briefly, we're going to touch on the fundamentals from the other night. We're then going to move straight on to the ECB. We're going to start with a statement, go through the key points from the statement. We're going to move on to the Q&A, discuss what came out of the Q&A, what we actually learned from the Q&A, and then the market outcomes. This is the most important part. What actually happened in the markets? How did the markets digest what Draghi told us? Did he tell us anything new? Okay. And then what we're going to do is look at what can we expect to see in the days ahead. What is likely? Remember, a lot of hedge funds, a lot of institutions go away tonight. They take Draghi, they read, they understand, they interpret, and tomorrow they come in and they put those positions on. So what can we expect to see tomorrow and the days ahead? We're then going to move on to a Bund auction. Okay, I'm going to show you what a Bund auction looks like on the chart. Then I'm going to show it to you on the ladder. I'm going to show you how to read and interpret the price action, and then how to make some money out of it. We're then going to move on to oil. Okay, I'm going to discuss oil fundamentally. We've had some very important data today out of the oil, but I'm also going to show you what the chart looks like. Okay, we're approaching some very important levels, and oil is looking good from a trader's perspective. Our quiz question for today: what new information did #Draghi give us today? Question mark. Okay, so let's move on to the fundamentals. Overnight, nothing major but China. So we had the Chinese GDP. New data showed China's gross domestic product for the first quarter of 2015 grew 7%. Okay, expected was 7.1, so a small little miss on the downside. Now, the importance of that effectively is everyone is coming out and saying now further stimulus is coming down the line. Right? It is expected that in the weeks and months ahead we are going to see further triple R cuts and further interest rate cuts. Make sure you understand the difference. A reserve cut is very different to an interest rate cut. Right? China has a tendency to prefer using triple R cuts or doing 7-day repo operations simply because they're short term. Right? Effectively, they can manage monetary policy with a 7-day operation a lot easier than cutting interest rates. They don't want to cut interest rates and then 1 month later raise interest rates. Okay, so keep an eye on that. Again, make sure you understand what you're going to trade when you do that trade. Okay, so that's the overnight fundamentals. Nothing major. As you can see, when we came in this morning, the Hang Seng was finally down. Okay, so again, note, Hang Seng was down 2 and a bit % today. What that's telling us is that this is a market that's going up 5-6% in 2 days and then dropping 2% in a day. All right, it's very much a speculator's market. So yes, it can be traded. Yes, there's good opportunities, but just remember, it's not a market you want to go against the herd. All right, and it's also very much a market that's likely to overshoot value. All right, it's going to become exuberant beyond valuation. All right. But then equally, once it does turn, it'll very aggressively turn around. Okay. Put that on. Thanks. Okay, so let's move on. ECB, get your statements up and let's go through this. I'm going to try and get through this statement quite quickly because effectively it wasn't a great deal. So let's move to paragraph 3 where he talks about his introductory statement. All right, he says, he's talking about now the asset backing. He says purchases are intended to run until the end of September 2016. In any case, until we see the sustained adjustment in the path of inflation. So what he's telling us, they will do QE until inflation gets back to where they want it. End of story. All right, you'll see he got queried on this in the Q&A, and we'll discuss that very briefly. But effectively, he's just told us they're doing QE until inflation gets back. All right? If inflation gets back sooner, well then they can slow QE. If it doesn't, they can increase and continue QE. It's as simple as that. It's open-ended in nature. Right? He then said, when carrying out its assessment, the Governing Council will follow its monetary policy strategy and concentrate on trends in inflation. So he's telling us that the ECB is targeting inflation. All they are concerned about is inflation. Right? Just like the Fed is concerned about the inflation, right? So too are the ECB. Right, so basically, the most important data coming out of Europe for us as traders is not the PMIs, it's not the retail sales, it's not the unemployment or the zoos. Right? Those are all secondary backdrop data. Effectively, it's the inflation. Okay. Then, move on to the next paragraph. He talks about the implementation of QE, how it's done so far. And he basically says the volumes are in line with what they announced, i.e. the 60 billion. And he says, in addition, there is clear evidence that the monetary policy measures we have put in place are effective. Like we said, he has to be positive about this. So he's saying, 1, we managed to purchase exactly how much we said we would, and 2, it's working well so far. Right, next paragraph. He then goes on towards the back end and he says, effectively, with all their monetary policy in place, what he's saying is, together, such developments will lead to a sustained return of inflation towards a level below but close to 2% over the medium term, and will underpin the firm anchoring of medium to long-term expectations. Okay? So Draghi's reiterating, he's telling us that he believes QE will effectively get them back towards their mandated 2%. Okay? At no point in that first section, the first opening paragraph as they call it, at no point has he come out and said, we're concerned, there's deflation, we don't have enough bonds to buy. Okay? In essence, that is a very upbeat, positive Draghi. Okay, no, it doesn't use the word hawkish, but a very positive, upbeat Draghi. He's upbeat on the economy and how QE is doing so far. In essence, what we've learned from that is nothing new. We've not received any new information, but we've just gotten a better idea or an understanding of how the ECB and Draghi is thinking. Right, then he goes on and he talks about the assessment in greater detail. Very, very briefly, I'm going to go over it, just shoot it down, write these points down. These are the important points. Towards the first paragraph, so at the bottom of your page 1, he says, moreover, the lower level of price of oil should continue to support households' real disposable income and corporate profitability, and therefore private consumption and investment. Furthermore, demand for euro area exports should benefit from improvements in price competitiveness. So, in other words, what he's saying is that gamble, gamble, I'm so flipping lucky because, you know what, 1, oil continues to go down, which means consumers have more money to spend, more disposable income, and 2, okay, because of the US now looking to start hiking rates and the UK moving towards that part of the cycle, effectively the euro is being whacked. So it's making Europe's exporters more competitive. Right, so that's what he's telling us. He's telling us these are the positive upside effects that we are currently seeing. This is what's going to allow Europe to effectively recover, he hopes. Alright, we then move on. He then talks about inflation. Very important, guys. Always read his inflation section. He says, according to the Eurostat flash estimate, Euro area annual CPI was minus 0.1 in March, up from minus 0.3 in Feb, up from minus 0.6 in Jan. So effectively we've gone minus 0.6 to minus 0.3 to minus 0.1. Alright, but now, this is why you read it. Very important. He then goes and says in the next line, this pattern largely reflects an increasing oil prices in euro terms. So in other words, he's saying the reason inflation is lifting is not because of core inflation. It's not because the consumers and the institutions are spending more. Okay? It's simply because the price of oil in euro terms has started to tick up. He then goes on and says, on the basis of the information available in current oil futures prices, annual HI CPI is expected to remain very low or still negative in the months ahead. Okay, so again, he's telling us that inflation is going to remain negative. So don't read when the newspaper comes out next month and says inflation heading back towards negative. Doesn't matter. Why? Because it's priced already. Draghi's told us it's their expectation. And remember, the markets are forward-looking, not backward-looking. So if you want to make money on this inflation concept, what we actually want to see is inflation start to become positive. Okay, if we start to see very positive inflation, that will effectively get the markets to start moving. That'll get bond yields to rise, okay, and that'll get the ECB really, really, really excited. Okay, let's move on. He then goes and talks about loan dynamics, 2 or 3 more paragraphs on. Right, and he basically says, the annual rate of change of loans to non-financial corporations was minus 0.4 in February after minus 0.9 in January, continuing its gradual recovery from a trough of minus 3.2 in 2014. Okay, so effectively what we're saying is that the banks are starting to lend again. Yes, that's what we want. We want the banks, now that they've repaired their balance sheets, we want them to start lending to corporations. Right? He then, however, goes and says, despite these improvements, the dynamics of loans to non-financial corporations remain subdued and continue to reflect the lagged relationship with the business cycle, credit risk, credit supply factors, and the ongoing adjustment. Okay, so effectively what he's saying is that, yes, there are some positive signs that loans are starting to be extended. However, there's still a lot of things and a lot of structural issues that need to be improved before we can actually start to see some real growth. Okay, and it's that real growth that he wants, guys. Remember, what drives an economy? It's effectively if a company phones you, whether it's a big one or small, and says, listen, I want some money to invest in this thing we can build because we see there's demand for that product from the consumer. Okay, that's what drives an economy, is growth and building. And it starts with loans from the banking sector. Right. He does go on to say the annual growth rate of loans to households increased further to 1% in February after 0.9. So again, we're starting to see households pick up after obviously the slump of the 08 crisis. Okay, very important. Consumers play a very important role in this recovery. It's effectively them that are going to drive part and parcel of the recovery in Europe. Okay, a lot like the US recovery now is driven by the consumer. Europe's also got a very big makeup. A lot of the growth in Europe comes from the consumer. Unfortunately, there's lots of old people, so they don't like spending money. But that'll change. Okay, so let's move on then. I'm just going to quickly go right towards the end. He then goes on and says, he talks about in summary. Okay, in summary, what he's feeling and what he's thinking. He's kept it more or less the same. But what he said is, in particular, in order to increase investment, boost job creation, and raise productivity, in other words, to get Europe going again, he says, we need implementation of product and labor reforms. In other words, what he's saying is that I can make interest rates negative. I can make it free money for people to borrow. However, if there aren't the right channels or there aren't the right ways to get that money into the real economy, it doesn't matter how low interest rates are. If banks don't want to lend, if companies don't want to take risks, then it doesn't matter where rates are. We're going nowhere fast. That's what he's saying. He's saying countries like Italy, like Spain, they need to accept these reforms. They need to change the fact that you can't have all these restrictions on labour. Okay, a very good example is in Italy. Okay, to become a taxi driver in Italy, you have to pay 100,000 euros to buy a license to be a taxi driver. Okay, that's the kind of restrictions they have in a lot of the countries in Europe. You can't just enter into any part of the labour force. Okay, there's a lot of restrictions. You can only study certain engineering courses. All right, if there is a need for it. If there's too many engineers, you can't study that course. Okay, so that's the kind of restrictions he's talking about. Change. Let's get going again. All right. And effectively, he then also says fiscal policy should support the economic recovery while remaining in compliance with the Stability and Growth Pact. So what he's saying is, Germany, hello, can you start spending? Start repairing those roads, start building some bridges, start doing something. Stop sitting on a pile of cash and building up all these surpluses and start spending so we can get Europe going again. Okay, that's effectively what Draghi's trying to say. Now, what you have to ask yourself, if you understand the ECB, is this is the same rhetoric we've had for months. Okay, Draghi's been going on about this for months and months and months, that the central bank cannot do everything for the recovery. They can only go so far. It's then up to the countries to actually push it further. Got that? Okay, that's the statement. Let's move on. Q&A, this is the fun part. So after getting graffiti or whatever thrown at him, and Draghi looking very, very scared, okay, we finally got to the Q&A section. Now I'm going to go through this. Very important, guys. The Q&A gives you a lot of information about what Draghi's thinking. Okay? And when you get a boring statement like that, or not a boring one, but when you get a statement with no new information, it's the Q&A when you want to look to the opportunity. So, very briefly, first question came in about Greece. He then came off about Greece, and they were asking about what happens if Greece leaves, and blah, blah, blah. And basically what he said, someone asked, is there an upper limit on how much support the ECB will give Greece? And he came out and effectively just said, no, there isn't, it's up to Greece. Okay, the ball is in Greece's court now. Either they accept the reforms and get on with it, and we give them that 7.8 billion that they need, otherwise they default, and then we continue in that direction. Okay? But he wasn't wanting to talk about Greece. What he did tell us, at present, the exposure of the ECB to Greece is 110 billion, and it's the highest out of all the countries in Europe. Okay, so what you have to ask yourself is, if Greece leaves and defaults and decides to leave the euro, don't forget that that effective loss is going to be shared amongst the other central banks. Okay, and that's why, if you understand what's going on with Greece, right, this is very much what they call game theory. Right? The risk or the cost of Greece leaving Europe is substantially higher, okay, than the cost of bailing out Greece again and again and again. And that's why what you're seeing right now on the surface and the talking and back and forward, okay, in essence all that is it's a game of chicken. It's a game of give me otherwise. Okay, and Greece is playing the game of chicken. Greece knows fine well that Europe can't afford for them to leave. Okay, not because they contribute, but because the losses are so great. The turmoil from them leaving will be far greater. The impact on the banking sector will be far greater. Okay, and that's why Greece is kind of playing hardline, because they know essentially they're going to get what they want. Okay, and that's unfortunately how we have to understand this. All right. Then let's move on. He then went on, and he was asked about the lack of bonds, so the lack of supply in bonds. And he came out and he used the word flexible. And I was quite surprised that the markets didn't move a little bit more on that. But in essence, what he was saying was that down the line we could become a little bit more flexible about what bonds we can buy. Okay, we spoke about this, some other agency bonds, Okay, some other institution bonds. Okay, like you got the European Investment Fund. So what he's referring to is that down the line, if we do run out of bonds to buy, well, we could start to look at other options of bonds. But in essence, he tried to hammer home the fact that there is enough supply. Okay, and that's very important to understand, because when I show you the charts, I'm going to show you that the market actually said, up yours, Draghi, you're chatting shit. There's definitely not enough supply. Okay, remember what I said to you, Draghi cannot openly come out and say there is a lack of supply. Otherwise, the entire market will front run the ECB. Okay, we'll look at that a little bit ahead. He then was asked about an early end to QE. A stupid question. And he came out and he kind of laughed and said, it's like me after the first mile ever run saying, should I end this marathon early or whatever it was. Okay, so he tried to tell the guy, it's a stupid question. Why are you talking about the end of QE when we're literally 1 month or 6 weeks into it? Okay, but in essence, what he did want to talk about was that he spoke about their intention versus their expectation. Okay, initially, the ECB always spoke about expecting to do QE, and then they changed it from expected to intended. Okay, and that strong wording he tried to compare to the end of QE. So what he was saying is that they intend to complete this QE course. So it's a very high probability that they're going to see this full course through. Right. However, remember, right at the beginning of the statement, right, they've told us that it's all dependent on inflation. It's open-ended, dependent on inflation. Simple as that. That's all you need to know. Okay. Then he was asked what happens if Greece defaults. Okay, good question. And he basically came out and said, well, yeah, we haven't thought about that. Okay. And the reason I've put that down is simple. Right? Of course they've thought about it. Right? But the fact that he was so nonchalant, relaxed about it, you almost get the sense that behind closed doors something is going on. There's a lot of negotiations going on, a lot of talking going on. Unfortunately, none of us will ever know what goes on. Okay? It's only the top echelon that will ever actually know what's been happening. But he sounded very kind of, Greece is not going to default, don't worry about it, guys. Okay? And even if they do, there'll be some sort of a secondary plan in place for it. Right. Then, he was asked about a negative deposit rate cut. Now, we spoke yesterday in our briefing and we said there was a small pricing expectation of further rate cuts. Okay, there was a lot of questions about, can the ECB go further into negative rates to allow that negative 20 basis point cap to change? Okay. Now, we spoke about Mersch's comment. Mersch said theoretically they could go more negative, okay, but the cost-benefit analysis right now doesn't make sense. That was his comment. But effectively, Draghi came out today and said, no, we're not going further into negative depot cuts. Okay, so in essence what he's done, and I'm going to show you, and this is where the key trade going forward is for the next couple of days. What he's effectively done is he's now put a further supply cap. Okay, because what is he saying? He's saying, go on, test me, get to negative 20 basis points because we're not going any further past there. So what he's in essence saying is, come on market, get there quicker. Okay? And that's what the market's going to do. The market's going to get to those negative 20 basis points even faster now. Okay? Because when a market gets given a target, they want to test it. Right? It was the same as the cap that we had, the 120 euro Swiss. They want to test that cap. And they're going to test the negative 20 basis point cap very, very soon. Okay, so keep that in the back of your mind. That was, okay, in my opinion, a very strong wording from Draghi. He's completely ruled out further cuts now. Okay, and that's interesting because now, if the ECB want to increase supply, they've got two ways to do it. They change the 25% maximum allowance that they can buy of any country, in which case once they're done buying Germany, they'll all move to the likes of Lithuania and the smaller nations, Cyprus and whatever, all the other nations that have a very small bond market. And the other option is obviously if they create other types of bonds that they can buy, i.e. agencies, i.e. institutional type bonds. Okay, you all got that? Good. Let's move on to the market outcomes. Okay, so first up, let's talk about the first market I want to get for you. Okay, let's talk euro first. I think the euro was probably the best to look at. Okay, so very briefly, let me shut the lights off quickly. Okay, so very briefly, the euro kind of opened up I think for the first 45, 50 minutes, sorry, not 45, for about the first half an hour, nothing really happened. And we'll go through the ladders very quickly and I'll show it to you, but nothing really happened initially. Okay, but what we did see was we start to see the euro kind of holding higher prices, slowly but surely. You can see here, tail, tail, tail. Now whenever you see 3 tails in a row during a conference that should be giving you more information, that's telling you almost a lack of interest. Okay, if the market had really picked up on something important, it wouldn't be doing that kind of resistance. However, once he came out and he kind of said no to the deposit rates, right, we did get a bit of a continuation move in the euro, and we got another, I think it was about a 60-tick move in the euro all in all. Okay. Subsequently, what have we seen? It reversed, and now it's pretty much bang smack where it began. So do you think we've learned any new information from this market? Simple answer is no. Alright, let's move on to the okay, get a little chart up here for you. Okay, just bear with me one sec. Okay, so the button came out. Just going to make us a little bit of a short time, right? Right, so the button came out, as you can see. We started out somewhere around here. The button went nice, well, went up relative, okay? And then did a little bit of accumulation, so a little bit like a flag, but effectively you could see someone was accumulating a position. Once he had gotten everything he could off the sellers, he then went back to the market. He started bidding the market back up and bidding the market back up. Okay, so effectively, we started the day at 61s. We're now trading somewhere around 96s, so plus 35. So for some reason, something's got the bond market's bid. Okay, whenever we see that, the euro hasn't moved. Why have the bond markets moved? Okay, so let's look at the euro stocks. Let's see what the stocks. If we can get a little bit of a story from the euro stocks. Okay, so we look at the euro stocks. Now remember, bear in mind, the trend on the day in the euro stocks was very much a P-type profile. So there was a lot of sort of a expectation that the euro stocks would likely test the highs and push higher. Right? So the ECB began, and we effectively started somewhere around here. The market kind of drifted sideways, 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 sold off. Okay, so net, where are we at the moment? Nowhere. So we haven't moved on the ECB. So the stocks tell us nothing new, or the equity markets in Europe tell us nothing new. The euro tells us that Draghi's told us nothing new, yet the bond markets have moved pretty aggressively. So we need to ask ourselves why. We can't just, remember guys, I know if you're not a bond trader, I know you're not going to pick this up, but you cannot as a trader sit there and not interpret actually why the bond markets are moving. Because effectively what's going to happen, and I'll show it to you down the line, and in fact I'll show it to you. Okay. So what I'm leaning on, and you're going to need to see it on a euro-dollar chart. Okay, this is the euro-dollar, and down below here, what you've got is you've got a 10s, 30s flattener. Okay, so it's the spread difference between a 10-year and a 30-year bond in Germany. Now, I've been telling you and teaching you for the last couple of weeks that as we get to negative 20 basis points, or the 5-year and the 6-year and the 7-year get closer to that negative 20, the ECB has to start buying further and further along the curve. Okay, and because of that, if they can no longer buy 5-year, then the 5-year will no longer go up, but the 7 and 8 and 9 and 10-year will start to go up. And that's what's created this flattener trade. Now, that's the previous ECB meeting. Okay. And what you can see since that meeting is the 10-30 curve flattened from 54 basis, okay, all the way down to, call it 40 basis points. So we had 60 or 26 basis points of flattening since the previous meeting. Right? The curve then did what? The curve went sideways. Okay, it's been stuck in a 4 basis point range for almost the entire month. Right? And now all of a sudden today, well, what did we start to see? We started to see this flattener trade start to price again. There was a little bit of an aggressive flattener going through the market again. Now the question you have to ask is why? What is creating this? And in essence, what it is it's the fear of lack of supply. Please guys, if there's one thing you can understand from today, it's that the market does not believe that the ECB will have sufficient bonds to buy. There's a complete disbelief. And that disbelief is creating a trade opportunity for traders. And that is a flattener, not just in the bund, but the OATs, but the BTPs, all the bond markets. Okay. Any questions about it? Please make sure you understand that. So why am I showing this? Because they're all linked. Okay. If you look over the course of the last month. Note, when the euro bottomed, the euro dollar found a bottom, note what the spread did. It found a bottom. The euro then rallied. What did the spread do? It then steepened. Okay? The euro then came back. What did the spread do? It came back. The euro then went up. The spread went up. Okay? And effectively, since the euro has been coming down, what's the spread been doing? So suddenly we're picking up on a very strong correlation here between the German bond market and the euro FX market. So shock horror, if that euro takes out 104.50, what do you think that trade's going to do? Okay, you don't need to be a rocket scientist to figure that out. I'm giving you guys all a free opportunity to understand what the hedge funds are going to be thinking about tonight, because that's exactly what they're going to be thinking. They know these correlations, and they're the ones that will be putting these trades on tonight. Right? And so should you guys. That's the whole purpose of this debrief, is to show you guys where the money is going to come from in the next few days. Okay? More importantly, how are we going to make money out of it? Well, it's simple. We need that 104.50 to go. Okay? Effectively, that is the key level. Now, if you're a Euro stocks trader, right, like I said to you, all of them are linked. We know fine well if the euro weakens, what does the stocks do? Okay, the stocks goes up, or European equities outperform. Okay, so right now what we're seeing is, if euro goes down, it means the stocks go up, and the Bund spread, or the German bond spread, okay, tends to flatten. There's your three opportunities, guys. Those are all linked. That is the trend in the market right now. Okay, you don't need to do anything other than play that trend. Okay, so if you see that euro taking out that 104.50, what are we going to do in that euro stocks? Are we going to look to sell it as it goes up? No. Why? Because we're fighting a bigger trend. We're fighting the bigger play in the market. Okay. Equally, if that euro starts to go bid, right, let's be careful trying to buy that euro stocks on the way down. Right, we know that euro stocks is nearing overbought territory and could pull back 1 or 2 or 3%. Okay, so let's not be silly. Of course we buy it so long as everything suggests it's a buy. But if we start to see this break down, let's be careful trying to be too aggressively long. Right, any questions about that, guys? Do you understand how it all works together, it all comes together in the end? Excellent. Okay, so that's effectively the three markets. That was the market result. The bond markets gave us the information. The bond markets told us what they think about what ECB has delivered to us. And they've told us, we don't believe that there is enough supply of bonds. You're wrong. That's what the market's telling the ECB. Now again, who's going to win? Either the ECB is going to win or the market's going to win. How is the ECB going to win? They have to make the market believe there is sufficient supply. They can do that in one of two ways. Right? They can verbally come out and say, trust me, there is sufficient supply. Has that worked? No, because Draghi has just effectively said it. Or they can come and change the conditions. Okay? And the other one is the, like I've been telling you, the Draghi gamble, which is he needs the US to start normalizing rates. You all got that? Everyone happy with that? Okay, awesome. Let's move on. Let's quickly go through the video. I don't want to spend too much time on it. As I said, there's nothing major going on. What I would say, there we go, let's go over here. I'm just going to push play and fast forward a little bit, but I think the key to watch, if you wanted to trade off anything, I still think the euro was the key off the negative depot rates or the bonds. Okay, what I would say is, if you want to trade the bonds, keep an eye on this little market here. That's the Boxall. Okay, you'll see. I'm going to fast forward a bit to where he mentioned the negative depot rates. Okay, then you can at least see what the market's reaction is. Okay, so somewhere around here, let's go back a little bit. Okay, so he's mentioned the negative depot rates, yeah? Oh, let's go back a little bit further. Okay, so let's just watch out. I just want you to get a pickup for when he actually mentions the negative depot rates. Okay, there, bang. He's mentioned the negative depot rates. Euro suddenly blipped up quickly, and effectively, let's watch that Boxall. Okay, Boxall goes bid, blips up, someone sells it. Now let's see how that Boxall responds. Let's try and remember 177.80 and see how the market responds off this comment. Okay, nothing aggressive, nothing major. So it's almost like the market saying, well, we did know that it was unlikely, but what are the bigger implications of this? And I think what you'll start to see is, as this euro starts to go a little bit more aggressively bid, you'll start to see this Boxall pick up a little bit. Okay, so let's just see More importantly, I want you guys to watch what happens. Okay, so we've got the Boxall making a new high. What happens when that Boxall makes a new high? What does the Bund do? Okay, so let's look. Remember, this is an increment of 2 ticks. So let's see how the Bund and the Boxall relationship looks. And on this side, let's see the bobble. So there we've got a whole 5, 10, 30 type play. Okay, so the bobble high is 71s. Okay, so what we can see, Bund's going down. Bund's gone down 3 ticks. Bobble's gone, or Boxall's gone up. Okay, so that's a flattener trade. What's happening is people are selling Bund, and at the same time they're buying Boxall. Okay, equally, if you want to do 5 10s, they're selling the bobble at 71s and they're buying the Bunds at 80s. Okay, let's keep watching. 80s, 92s. Okay, keep watching. See what happens. See what happens. Okay, 96s trade. What's the Bund doing? Note the absorption in the Bund here. Okay, so someone's sitting on the offer, absorbing, taking, whilst the Boxall's rallying. Okay, that's very typical when there's a flattener trade being put on in the market. Please guys, if you want to learn one thing about bond markets, remember, outright traders constitute about 5% of the entire market. No one trades outright. Okay, outright is left for us gamblers. Okay, banks, institutions, hedge funds, they don't trade, they rarely trade outright. What they'll typically do is trade in a spread type format because that gives them a little bit of a hedge, an offset against their risk. You all got that? Okay, I'm going to fast forward a little bit. Let's just see, remember 82s in the Bund and 98s in the Boxall. Okay, so now we've got the double O's in the Boxall and Bunds hasn't moved. Okay, so let's see what happens when the Boxall takes that high. Note the Bund's going down, the Boxall's not going down. Okay, Bund's still on 80, Boxall going back to the highs. Okay, let's keep it going, let's keep it going, let's keep it going. See if we can get one more up move here. Okay, so again, note, Bund is 4 ticks lower, Boxall still on the highs. Okay, so you don't necessarily have to be selling Bund. What's happening is the Bund's being sold while the Boxall's being bought. That's the fattener being put on. You all got that? Any questions? Good. That's the ECB video. That's the ECB, guys. Done. Done and dusted. You've done your debrief. Make sure you prepare for tomorrow. Make sure you understand what I've told you about the bonds. Okay, let's quickly move on to the rest of the debrief, and then we can get you guys out of here, get you going home. So, auction. Let's talk auction. I want you guys to understand this because you traded this today. So let's go BD hash. Right, remember what I said to you. Bond auctions have supply. In other words, when there's a supply in the market, it makes prices go down. Why? Because if I'm auctioning or I'm going to an auction and I've put in a bid to buy a certain number of bonds, as soon as I know I'm going to get those bonds, I want to hedge myself out. Okay, remember what a bank will do effectively is they will buy, let's say 1 billion worth of bonds or whatever, let's say 1 million. Okay, they're not buying it for themselves, they're buying it for a client. Right? As soon as they know where the bond's going to price, they can effectively go hedge themselves in the futures. And that's why you typically tend to see a little bit of sell-side action in the bond markets prior to the auction result. So let's get to 10:30, somewhere around there. Okay, so 10:30, the auction shuts in Germany. Right? At that 10:30, that's the cutoff. That's the point where the yield is decided. Okay, and what we effectively typically tend to see is a little bit of sell-side action into 10:30, not after 10:30, into 10:30. Okay, so if we were to take this 10-minute period prior, as you can see, there was a little bit of sell-side action, but equally quite a lot of buying. Now, when you get a situation where you get a lot of, okay, in this case, it wasn't, I'll show it on the ladder, it wasn't necessarily there was no selling, it was just there was a lot of absorption from the buyer. Someone was using the auction to get a very big fill off on the buy side. And I'll show it on the ladder, you'll see it in a minute. But effectively, once the auction result comes out, what do we get? We get a up move and then continuation. Okay, let's go through the video so I can show it to you quickly. And I'll show you what I mean by the absorption. Typically, you won't get this kind of absorption. It's very unusual to get this kind of an auction, absorption, but it does happen from time to time. Okay, so the bond is the, let me get you there quickly. Okay, so the bond is effectively that one over there, the 61s. Now note, what I want you to watch, I just want to see when, this is about 10 minutes before, so I just want to get to the point where the price action picks up. Tell you when it's there. Okay, excellent, so let's watch. Let's see what happens in terms of price. Okay, note, we've done 15,000, 19,000, 12,000. Okay, let's see what happens to those three prices over the next 2 or 3 minutes. I'm going to speed this up a little bit. Okay, so let's watch the clips going through. So there, 330 buy. Sorry about that. Okay, so someone's buying there, 500 contracts. Note the absorption. Okay, so we've got a buyer in the market. What do we want to see? We don't want to see a buyer, we want to see a seller. Okay, we want to see that sell side price actually come in. Note again, someone absorbing. Okay, this is typical. If I'm auctioning, if I want to hedge before the auction, I can absorb or I can go to market. But if someone's going to buy it off me, why would I go to market? Okay, so note someone absorbing, note the reload. 200 a market, reload. 400 a market, reload, reload, reload. Someone's just taken 2,000 there, 2,500 at 62. You see that? They went from 2,000 to 2,700. Okay, and reload. Now it's to 5,000, 5,600. Okay, 5,800, 6,000. We've done 4,000 contracts in the last 30 seconds at the same price. Someone's absorbing the offer. Okay, this is the auction going through now. Note the 700 lot. So note the size. You'll typically see a little bit of size come in around the auction or around the hedging time. Okay, but now that he's absorbed, if he's got more, we want to see him go to the market. We want to see that buyer disappear and see him go to the market. Okay, note, this is roughly about 30 seconds before the 10:30 settlement. What you typically want to do is get out before the 10:30 settlement. Okay. Very important when you do see this kind of buy-side action. Remember, at auction time, there should only be a seller. So the fact that someone's buying it is telling you what? It's telling you there's a big-ass buyer in the market. Be careful. Okay, you're getting a clue here. You're getting told that the price is not doing what it should do, and it's only because there is a buyer in the market. Okay, so let's see what happens once the auction result comes out. Okay, I'm just going to fast forward this roughly. Okay. Excellent. Let's move on. Okay, and we're bang on 10:30 now, guys. So we're waiting for the auction result now. Okay, and let's see what happens. 10:30, 10:32. Okay. Now remember, there, bang, auction results out. Okay, we've seen the auction result, and they told us that it's 1.5 bit to cover. Effectively, the auction's covered. But now what happens? Okay, we've seen all that aggressive selling being bought up. Someone was buying pre-auction, using the auction liquidity. So now what we want to see is that buyer should still be there, and he should still want these bonds. Okay, so what you typically see post an auction is you tend to see a bid up, right? But when you get very obvious price action like this, you'll see in a minute once he goes to the market. So watch carefully now. Look at the selling, 35, 130. So someone's selling there. Remember, if I'm a buyer, I'll wait for him to finish selling, and then I'll go to the market. Okay, so let's see once he goes to market. There, bang. So he buys 400 a market. Let's see how he responds. Okay, so we got a buyer here. We can see the buyers there. And he doesn't wait for more selling, but he instantly lifts 61s, full through, and straight to 62s. Okay, let's see. Do we see any selling? Is there any clips going down now? Straight 62s, lift 63s, lifts the 63s. Okay, so now he's gone straight from 59s, lifted 60, 61, 62, and he's lifting 63 now. Okay, and he's straight on to 64s. So he wants the market now. He's desperate to get his fill. He wants to do his work. Okay, and 64s will go, and 65s will go. And note the important thing. Look at the seller. Okay, so someone's selling there. You can see he's selling. But what is he able to do? Note when he sells, what happens to the bid? It just gets reloaded and reloaded and reloaded. Okay, 5 lots, 87 lots go through. Right, we fast forward this a little bit, we can see the outcome. As you can see, so he keeps selling. Remember, as a buyer, I'll let him sell as long as he wants to sell because he's giving me easy prices. But once the seller's gone, what am I going to do? I've got to finish this order up. I've got to get to the market. Right, you all got that. And eventually, it moves up the page. Okay, any questions about auctions, guys? Good, let's move on. Let's talk oil. Okay, oil's at a wonderful position now. Right, just, sorry, very briefly, let me show this to you. Okay, so over the course of the morning, that's what the Euro grid looked like. If you're going to trade currencies, make sure you have a grid up. What that grid tells you how are the Euro's major trading partners performing against the Euro. Okay, when you see that every single one of them is down on the day, you know that the Euro is weak. It's the weakest currency against all the majors. So you know there is some price or something going into that currency pair. Okay, equally, during the Draghi press conference, once he had told us no negative deposit rates, that's how it changed. So note the positive, positive, positive. Everything went back to flat, but then shock horror, it all went back to negative again. Okay, so we've got a little bit of dollar or euro, almost a little bit of a squeeze in the euro, but now it's reversed the move. So like Lee Gibbs said, what I would say is that euro looks adamant to be testing 104.56. Write that level down, guys, please. You have to be watching how that market responds, and not just if you're a euro trader, but if you're trading stocks, you're trading bonds. Okay, it's going to impact, and we are very likely, after what we saw today, that very aggressive reversal, we're very likely to see 104.50, if not tomorrow, Thursday or Friday. Okay, we're going to see it in the next 2 or 3 days. So keep an eye. More important, remember, that is the yearly low. Remember that pattern I showed you in oil, the failed break to the downside, how the market couldn't sustain lower prices. Okay? Equally, if you tune into the debrief tomorrow, and for all of you guys, I'm going to show you a trade opportunity of a lifetime. Okay? What I do want you to do for your homework today, write this down. Okay? There was another market back in 2011, 2012 that got to parity against the dollar, and that was the Aussie dollar. Okay. It got to parity simply because there was a boom in there was a boom in Australia for their commodities from China. Equally, they were the only AAA rated bond that had 4.5% offering in yield, whilst the rest of the world was in a crisis, 2009 crisis. Okay. So go and look at that chart, and tomorrow I'm going to show you an awesome trade opportunity. Okay. A lot of you can make good money if you just think about it. Just have a pair of kahoonies. Okay, let's move on. Oil. So, what we see in the oil today is the first. Okay, we were expecting a build of 4.5 million. What did we get? A build of 1.2 million. Okay, now the last 3 weeks, we've had 10 million barrel builds week after week after week. And price has just been drifting a little bit higher, lift a little bit higher, a little bit higher. Today, suddenly, we don't get a build. Okay, we get a less build than expected. Now, there was a big article in the newspapers this morning about how over the first quarter of the year, there's actually been a lot more demand, and this comes from the EIA, there's been a lot more demand for oil this year compared to last year, and that's because of the very cold conditions we've seen in Q1. Right? However, remember, that data is only starting to filter through now. So what they were saying, what the FT article was saying, is that it's murky waters now in terms of understanding the fundamentals of oil going forward. However, what I will say, when you get a nice little data piece like that, and you get a little bit of price action, like I'm going to show you now on the board, okay, it's time to start paying attention. That's not the right one. We don't want that one. Let's get, one more sec, guys, sorry. I have not got the chart yet. Okay, what I will say, I'll draw it for you. I'll make a little pretty picture here for you. That's not the oil currently. What we've actually seen is the oil scaled above here. Okay, it got to that 200-day moving average. All right. It then came all the way back. We had those couple of days where the market felt very aggressive and felt like it had a head fake. But since then, what we've done is Monday, we've actually closed above this 200-day moving average for the first time. No, this is the first time. Sorry, it's a 100-day moving average. Okay, it's the first time we've closed above it. And then today, we've actually taken out that area, and we're now looking to move higher. Okay, on the future space, what I would say is 56 bucks, guys, 56.10. That's the last level of resistance. That goes, oil's moving back up to 58, 59 bucks a barrel. Okay, longer term, yes, we're still very much in a downtrend. Medium term, very much in a downtrend. But short term, price is moving higher. Okay, it's not based on my opinion, it's what price is showing us. It wants higher levels right now based on how the market's interpreting. Okay, please keep an eye on oil, guys. Awesome opportunities there. Make sure you understand. You know, don't try and fade it until it's found some sort of a top. But there will be good opportunities to sell this at higher prices. Okay, remember, fundamentally, we still are in a bear market. Okay, and then last but not least, yeah, can you put those lights on for me, please? But last but not least, I just want to show you one more chart. If you want to just put those lights on very briefly for me. Okay, one more little for the ECB. Okay, just last thing. Okay, this is what Dan was talking about. Dan and Marco were talking about. Effectively, what this is the Bund versus the Italian BTPs. Okay, it's the spread. It's effectively what's happening between the spread between Germany's 10-year and Italy's 10-year. Now, what I will say is since the previous ECB meeting, we're 14 basis points higher. Okay. Now, we've not been given any new information. We've been told that the ECB is going to continue doing business as they've been doing, i.e. buying shorter dated bonds in the core and buying longer dated bonds in the periphery. Alright, so what do you think is going to happen to that trend? It should continue to trend now. Again, another very obvious trend opportunity for you to make money on. Okay, please go away. You can shut the lights on now. What I would say is, make sure you go away today, and first things first is just make sure you answer that question, okay, which is, what new information did Draghi give us today? What did you learn? Please guys, if you want to learn Draghi, I promise you it took me a year to learn Draghi. In fact, it took me a year and a half. I used to be just like you. I was like, it's so hard and I don't understand it. But when you read, you start adding. When you learn and listen, you start adding to your information. Okay? And that's how you start to understand what the central bank's all about. I can promise you, you want to make big money in this job. Right? All the macro hedge funds, all of them know precisely what every single central bank is about. Okay? And that's not because I tell you that. That's because at the end of the day, when the Federal Reserve tells us where interest rates are going, that will dictate where every other market is going. It doesn't matter what you trade. Okay? If you do not understand what the Federal Reserve is telling you about rate policy, you are shooting yourself in the foot. Okay, so please make sure you understand the ECB. If you have any questions, you're welcome to come to me. Otherwise, have a good evening, guys.